Julia.
Melissa, thanks so much. And Bob Chapek, Disney CEO, thank you so much for being here today to talk about what's going on at the company. A better than expected quarter on a number of counts. But let's start with streaming. You added 11.8 million Disney Plus subscribers. I know there's a lot of concern after a slowdown last quarter. What drove those numbers?
Well, our great content is what drives our numbers. And you're right, we had a great quarter across the board, whether you're looking at the Disney Plus sub ads of 11.8 million, if you're looking at a record-setting domestic parks performance, coming right on the heels of COVID, that's very, very encouraging. And just the overall performance of the company with earnings per share of $1.06. That's a really strong performance, and we've always said we're in this for the long term. This is a long-term game, not really a quarter-to-quarter type proposition, and I think the long-term health of Disney content really drives the day. And to be honest with you, our great cast members, we have roughly 200,000 people that work tirelessly every day to get us through the pandemic and drive us to these kind of results.
So to go back to Disney Plus in particular, because I know that Disney shares really dropped on the Netflix warning that there was going to be slower growth in this quarter. What are you seeing right now, just so far into 2022? And what's your sense of your ability to hit those long-term targets that you set for 2024?
Well, we're reaffirming our guidance of 230 to 260 as we gave last December. That's been our target. That continues to be our target. And really what's driving is what we've said, great content. We'll have more franchise added content on our big franchises added this fiscal year, double what we had in 21. So that new content really is what drives it. Quarter to quarter, because of the pandemic, we have a little gaps here and there in terms of the content. And so it's not a straight line growth every quarter, but we're reaffirming that 230, 260. We feel very good about that.
Now, I have to note that you have an Encanto poster behind you. That was a film that you put in theaters for a shortened exclusive window. I'm curious how the growth this quarter with films like Encanto makes you think about the importance of investing more in content and putting more theatrical releases on the platform sooner rather than that traditional window.
Well, we've always said we're going to have a flexible distribution strategy right now, and the reason is because we're in a world of flux, changing consumer behavior because of the availability of titles in homes. Our consumers have had a chance, our viewers have had a chance to enjoy that. They love it, and at the same time, a lagged recovery, if you will, from COVID in theaters. And so we'd like to remain as flexible as possible, but we do believe in the future of the theatrical business, particularly for our big tentpole titles. Obviously, there are certain demographics that are slow coming back. The family films, that's one thing that's been a little bit slower. And the films that sort of go outside the big blockbusters, those are slower to come back. But we believe that we've got a lot of options between our theatrical exhibition releases, as you saw with Encanto, with a short window, or direct to our service, as you're seeing with Turning Red coming up in March. We're really, really excited about the options that we can give to our audience.